Welcome back to the deep dive. This is where we take complex information, stack up your sources, and really pull out the most important nuggets of knowledge, our goal, to give you that shortcut to being truly well informed. And hey, for those of you who love to see the data and the visuals come to life, remember you can find the visual companion to this deep dive and plenty of others over on our YouTube channel. That's Market Insight Cast. Today, we're embarking on, well, a really fascinating deep dive. We're looking at one of America's most iconic companies, Ford Motor Company, ticker symbol F. We're going to unpack its rich, vast history, explore its diverse current business operations, and maybe most crucially, analyze how this industrial titan is navigating the truly seismic shifts currently reshaping the entire automotive world. We'll also be dissecting its latest financial reports. We'll take you from those big macro trends right down to the quarter-by-quarter performance, just to give you a complete sort of nuanced picture. So strap in. We're about to fire up the engine and get started. Okay, let's kick things off. Let's explore Ford's core identity and its massive business footprint. When you think of Ford, right, your mind probably conjures images of a quintessential American brand, and you'd be absolutely right. This company boasts an impressive, 121-year legacy as a multinational automobile manufacturer. Its deep roots are firmly planted in Dearborn, Michigan. But what's genuinely impressive and perhaps often overlooked is how Ford has consistently evolved. It's gone beyond merely, churning out vehicles. They've truly expanded their reach into services, enhanced customer experiences, and critically, into software development. To me, this showcases incredible adaptability and I'd say a leadership stance in an industry that's perpetually reinventing itself. It's no longer just about selling you a car, right? It's increasingly about selling you this whole connected ecosystem. Their key business areas really underscore this diversification. First, and still very much the core, is vehicle manufacturing and sales. This is undeniably the bread and butter. A vast range covering everything from robust trucks, versatile SUVs, cutting-edge EVs, practical commercial vans, traditional passenger cars, even luxury vehicles under Lincoln. They've cultivated a truly broad and deep product portfolio. And here's a staggering fact that highlights their enduring market power. The F-Series pickup truck. It's held the title of America's best-selling vehicle for an astonishing 48 consecutive years.
48 years. It's almost hard to grasp, isn't it?
Exactly. That kind of sustained dominance in a single product line is almost unheard of in any major industry. And what makes that F-Series story even more fascinating is the significant internal shift we're witnessing. In Q2 2024, get this, a full 43% of F-Series sales were hybrid and plug-in hybrid models.
43%.
To me, that's a clear signal of their active and successful move towards electrification, even within their most traditional and, let's face it, most profitable segment. But as I hinted, it's not solely about the hardware anymore, is it? Ford is making a very deliberate, very significant lean into connected services and software development. They're integrating advanced embedded software directly into their vehicles, designed to enhance the driver experience in, really tangible and intuitive ways. Think about the Ford Pass app, for instance. It puts remote control over your vehicle literally at your fingertips. You can monitor its status in real time, even book service appointments right from your phone. And then there's Blue Cruise. That's their innovative hands-free highway driving system. And crucially, it operates on a subscription model.
Which is key, right? That recurring revenue stream.
Absolutely key, because it shifts a portion of their revenue from just a one-time vehicle sale to an ongoing, recurring income stream. It transforms the customer relationship into a continuous engagement. Next up, we have Commercial Vehicle Solutions, brilliantly branded as Ford Pro. Now, this isn't just some add-on, it's a dedicated business unit, and I think it's been a brilliant strategic move. Ford Pro seamlessly integrates their robust commercial vehicles with a comprehensive suite of services, sophisticated telematics, all specifically tailored for corporate clients. It's about providing holistic solutions for businesses, everything from streamlined fleet management to predictive maintenance. Ultimately, it helps companies run their operations more efficiently, reduce downtime.
And that commercial customer base tends to be pretty sticky, doesn't it?
Yeah.
More loyal than retail, perhaps.
Exactly. That focus on the commercial customer, where loyalty is often higher and needs are more specialized, provides a strong, defensible niche for them. And, none of this relentless innovation happens in a vacuum. It requires serious, sustained investment in research and development, R&D. In 2024 alone, Ford is slated to invest approximately $8 billion in R&D.
$8 billion. That's a serious number.
It is, and this isn't just for minor iterative improvements. It's focused on entirely new vehicle designs, pushing the boundaries of product development and critically advancing EV battery technology. We're talking about exploring and perfecting specific chemistries like NCM811 and nickel-9 batteries. These are truly at the forefront of battery science, aimed at significantly increasing range, improving efficiency for their next-gen EVs. They're also heavily investing in advanced autonomous driving systems, positioning themselves for the future of transportation, where human input might become optional. So just to give you a quick snapshot of their financial health, this is as of March 34, 2025. Ford boasts a market cap of around $44.8 billion. Their earnings per share, EPS, stands at $1.25, trailing 12-month revenue, an impressive $182.8 billion. They reported a gross profit of about $14.7 billion over the last 12 months and a dividend yield of 0.0523. Looking at their stock performance over the last year, the 52-week high was $11.90 and the low was $8.32. So when you pull all this together, it really paints a picture, I think, of a robust, diversifying company. One that's leveraging its traditional strengths while, in my opinion, aggressively innovating for the future.
That's certainly one perspective, and it definitely highlights Ford's immense scale and, its historical impact. No question about that. But what's truly fascinating, as you mentioned, is that 121-year history. While it's undeniably impressive, a testament to endurance, it also raises a really important and I think often overlooked question. How agile can a company with such deep roots truly be, especially when adapting to entirely new paradigms like software-defined vehicles and the rapid march of electrification?
That's the core challenge, isn't it? The legacy aspect.
Exactly. A century of building metal and engines creates a certain organizational inertia. It creates a deeply ingrained culture, a vast supply chain designed for a very different era. Pivoting from that, it requires not just significant investment, which they are making, but a fundamental, incredibly difficult shift in its corporate DNA. It's turning a massive ship. So let's maybe delve into some of the nuances, the underlying challenges within those very business areas you just highlighted so positively. While Ford's vehicle manufacturing undoubtedly benefits from that F-Series dominance, it's a powerhouse for revenue. No doubt we need to critically question the profitability across their entire vehicle range, especially those non-truck or non-SUV segments. Are they still being subsidized by the F-Series high margins? And if so, how sustainable is that in the long term, particularly as customer preferences keep shifting?
That's a fair point. Is the rest of the lineup pulling its weight?
Right. And the fact that 43% of F-Series sales in Q2 2024 were hybrids, well, while you present it as a successful transition, it could also be seen as just a necessary adaptation, a response to evolving market demand moving away from pure internal combustion engines. It's a pragmatic compromise, yes, but it doesn't necessarily screen clear leadership in full electrification when you compare them to pure EV players. It feels more like hedging their bets.
Hedging versus leading. Interesting distinction.
And when we talk about connected services and software, the inherent difficulty for traditional automakers to genuinely transform into software companies, well, yeah, cannot be overstated. Ford Pass and Blue Cruise certainly exist. They are steps in the right direction for customer engagement, I agree. But we need to compare their market penetration and, more critically, their actual revenue contribution against tech-native competitors. Think Tesla, right? Built from the ground up as software-first companies.
So is it really moving the needle financially?
That's the question. Is this truly a new, substantial pillar of profitability for Ford? Or is it more like playing catch-up in an area where they are fundamentally disadvantaged by their own legacy? The existing hardware architecture, the vast, complex supply chain, the traditional manufacturing mindset, all these make it incredibly difficult for Ford to integrate and innovate software at the blistering pace needed to truly lead and compete against those agile digital-first players.
Okay, and what about Ford Pro? You see challenges there too.
Well, Ford Pro is clearly a strategic strength in the commercial segment, no doubt. But it also has its limits. We have to question its ultimate growth ceiling. How much larger can this dedicated segment realistically get? And crucially, how susceptible is it to broader economic downturns? Those inevitably impact commercial fleet investment decisions.
Right. Businesses cut back on big purchases in a recession.
Exactly. They're quick to pull back on capital expenditures, and that could directly hit Ford Pro's future revenue streams and profitability.
Yeah.
It's strong, but maybe not invulnerable. Finally, that substantial R&D investment, $8 billion in 2024. While it sounds significant, really, it should be framed less as a luxury investment and more as an absolute necessity.
Just table stakes at this point.
Pretty much.
Yeah.
Given the dizzying pace of change in the automotive industry, the critical question here isn't just the sheer amount, but the efficiency of that spend. Are they getting a return on that investment commensurate with the competitive landscape? Specialized tech companies, even other established automakers, are pouring truly vast sums into battery and autonomous tech. Despite Ford's substantial investment, there's a very real possibility they could still find themselves behind these highly focused, centralized tech companies who've been innovating in these areas for longer. They're spending just to stay in the race, maybe not necessarily to pull ahead.
So more of a defensive spend than an offensive one, perhaps.
You could argue that. And looking at that initial financial snapshot you presented, yes, revenue's high, $182 billion, but the EPS of $1.25, relatively modest in comparison. This raises a crucial point about the inherent challenges of converting that high top-line revenue into strong per-share earnings. That's ultimately what genuinely benefits shareholders, right? Bottom line versus top line. Precisely. And the dividend yield, 0.0523, while positive, isn't exceptionally high, particularly in today's high interest rate environment where investors might find more attractive yields, maybe lower risk elsewhere, and the significant volatility. The 52-week high of nearly $12 and a low around $8.30. That suggests a meaningful degree of market uncertainty about Ford's future trajectory. Investors, judging by these swings, aren't entirely convinced about their path forward. That skepticism is baked into the stock's wide price movement.
That's a fair and critical analysis of the foundational challenges. It absolutely highlights the delicate balance Ford is trying to strike, a real tightrope walk. But let's pivot now and unpack the broader industry landscape further, because the automotive industry isn't just changing, it's undergoing a complete, almost tectonic transformation. And from my perspective, Ford is truly positioning itself to capitalize on these massive shifts rather than, being swept away by them. First, and arguably the most impactful, the EV transition. It's accelerating at an incredible pace. This isn't a niche market anymore. It's the undeniable future.
The momentum is certainly there.
It really is. We're witnessing a global surge in EV adoption. That's the single most important trend driving change. For example, in 2023, new car models across the board showed continuously improving CO2 emissions and fuel economy. That's directly attributable to the increasing production and sales of EVs. And looking specifically at the U.S. market, the battery electric vehicle market share reached a significant 7.46% in Q2 2025. That's a powerful, undeniable trend that Ford is not only embracing, but, I would argue, actively driving forward with its growing EV and hybrid portfolio. They seem to be aiming to lead in this crucial space. Then there's the profound evolution towards software-defined vehicles, SDVs. This is a fundamental shift. Vehicles are no longer just transportation tools. They're becoming sophisticated, connected service platforms.
More like computers on wheels.
Exactly. This expands digital connectivity exponentially, enables incredibly sophisticated data utilization, and crucially, opens up entirely new revenue streams through subscription models. Ford is investing heavily in this shift, recognizing it as an immense opportunity to build ongoing, lucrative relationships with customers, generate continuous income long after the initial vehicle sale. It's moving from transactional to relational. We also can't overlook the rapid progress in autonomous driving technology. The development towards Level 4 autonomous vehicles is moving at a breathtaking speed. This has the potential to absolutely revolutionize entire industries, ride-hailing, last-mile delivery, public transport.
The potential is huge, definitely. The execution, though.
Right, but Ford is not just observing, they are actively participating. They understand that being a significant player here is vital for future relevance and market share. They see it as an imperative. Furthermore, sustainability and stricter environmental regulations are huge drivers of innovation and consumer choice. There's an undeniable increasing interest from both consumers and policymakers in drastically reducing carbon emissions. Ford sees this not just as a compliance challenge, but as a golden opportunity where they can genuinely lead, not just follow, by developing truly eco-friendly vehicles. It's a chance to build brand loyalty and capture that growing segment of environmentally conscious buyers. And yes, market competition is undeniably intense. GM with 17% market share in the U.S. in 2024, Toyota holding 15%. Formidable players.
Absolutely. Stiff competition.
But Ford maintains a solid third place with 13%, which, for a company of its age and scale, demonstrates incredible resilience and a powerful brand presence, even in this fragmented environment. When you look at Ford's overall response strategy, I see it as truly multi-pronged and aggressive. It paints them as a forward-thinking player, proactively shaping its own future.
Okay, if we connect this to the bigger picture, while those trends you've highlighted certainly represent massive, unavoidable shifts, they also present monumental, almost existential challenges, especially for established players like Ford. It's one thing to acknowledge a trend host. It's another entirely to profitably adapt a century-old manufacturing giant, built on a completely different business model to it.
The execution is the hard part.
It's incredibly hard. Take the EV transition. While rapid, it demands truly immense capital expenditure. Designing new architectures, building new factories, retooling old ones, establishing entirely new supply chains for batteries, critical minerals. Many legacy automakers, Ford very much included, are still struggling profoundly with achieving consistent profitability in their EV segments. The crucial question isn't just if they can build EVs, it's if they can build them profitably at scale. And that's proving to be significantly harder than maybe initial projections suggested. The transition costs are just astronomical, and that burden weighs heavily on their current financials.
So the profitability piece is the real sticking point for EVs.
It absolutely is. And as for software-defined vehicles, this is an inherent, almost insurmountable challenge for companies that have historically excelled at hardware, at bending metal, optimizing combustion engines. Ford's effort to simplify its vehicle architecture, internalize software development, I agree, it's a necessary step, but it's an absolutely massive undertaking. It essentially requires them to shed decades of ingrained processes and dependencies.
Untangling a complex web.
A very complex web. Historically, they've relied on, over 150 external control modules for various functions. That leads to incredibly complex compatibility and IP issues. It just illustrates the sheer scale of the legacy system they are fighting against every single day. They risk being outmaneuvered by tech companies or EV natives like Tesla, whose core DNA is fundamentally software-driven, who don't carry this hardware baggage. Catching up to industry standards like the 5x faster processing, 14x faster graphics you mentioned, that's not necessarily leading innovation. Often it's just playing catch-up to what new entrants already do.
Just meeting the baseline.
Exactly. And whether Ford Pass and Blue Cruise subscription revenue, while promising, can truly move the needle significantly compared to their massive traditional vehicle sales, well, that remained the very big open question. Autonomous driving, another area with immense potential, yes, but equally massive R&D costs, incredibly complex regulatory hurdles across different jurisdictions, immense safety complexities requiring years of testing.
It's a long road.
A very long, uncertain road to profitability. Just look at Ford's past. Their significant partnership with Argo AI, ultimately ended, resulted in a substantial financial write-down. That implies their initial strategies in this incredibly challenging sector didn't pan out as hoped. Highlights the inherent risks and costs.
Learning the hard way, perhaps.
Perhaps. The $4 billion investment planned by 2023 for autonomous tech shows a sheer financial commitment. And CEO Jim Farley mentioning potential licensing possibilities in February 2025. That suggests a pivot away from full internal development. Could be realistic adaptation, yes, but it's also a clear concession of the immense difficulty of truly leading in this cutting-edge space on their own.
So maybe focus on integrating rather than inventing everything themselves.
Could be the strategy. Furthermore, persistent supply chain instability and relentless economic pressure, inflation, high interest rates, these aren't temporary challenges, they are constant, unpredictable threats. They directly impact vehicle affordability for consumers, making it harder to sell cars. They also significantly increase the cost of capital for Ford's financing arm, inexorably cutting into margins.
It's hitting them on multiple fronts.
It is. And while Ford maintains significant market share, intense market competition isn't just from traditional rivals. The market's fragmenting with new EV players, many unburdened by legacy costs. This intensifies pricing pressure across the board, demands constant, incredibly costly innovation just to maintain position, let alone grow it.
Okay, so let's get specific. How do you see their response strategies playing out against these challenges?
Right, let's critically analyze Ford's specific responses. Their EV and hybrid portfolio expansion, aiming for that ambitious 40–50% full EVs by 2030. Ambitious, yes, but the feasibility and, more importantly, the profitability of this target, questionable, especially given the current well-documented losses in their Model E division.
They've shifted focus slightly, haven't they? More towards profitability now.
Exactly. The recent shift to explicitly focus on profitability improvement and CO2 reduction, rather than just raw volume in the EV unit, strongly suggests initial EV efforts were simply not profitable enough. They're undergoing a painful, costly course correction. Their renewed focus on commercial vans and mid-sized trucks for EVs highlights a niche strategy, not mass-market EV dominance. Pragmatic maybe to find profitability, but it inherently limits overall scale compared to a full-line EV approach.
Finding profitable niches first.
Seems to be the play. That $22 billion investment by 2025 in connected EV development, It's a huge capital outlay. There are significant financial risks with such massive, front-loaded investments in rapidly evolving battery tech like NCM811, nickel-9. Their long-term viability or cost-effectiveness is far from guaranteed.
Betting big on specific technologies.
Big bets in a fast-changing field. Blue Oval City, their massive new complex, 500,000 EV trucks a year by 2025. Impressive scale, but will this vast capacity meet profitable demand? And will the production ramp-up be smooth without costly hitches? Big questions.
And the F-150 Lightning, it was leading EV pickup sales for a bit.
It was Q1 2024 leading the Cybertruck. 7,913 units versus about 7,100. But we need context. Total EV pickup sales are still a tiny, almost negligible fraction of overall F-Series sales. It indicates a very, very long road ahead for full electrification to truly impact their overall bottom line profitably.
Still a small piece of the pie.
A very small piece. Now, regarding their focus on profitability and market share, their continued reliance on high-margin trucks and SUVs, F-150, up 11.5% in Q2 25 sales, Bronco up nearly 45%, contributing to that 14.3% truck SUV market share. It's undoubtedly a current strength, provides higher margins. But paradoxically, it raises a critical question. Does this very dependence limit their ability to fully commit to and profit from the necessary EV transition? You're still heavily relying on a cash cow. That is, by all indications, facing long-term decline.
Can the old business fund the new one fast enough before it fades?
That's the tightrope, exactly. And finally, that $3 billion term loan credit agreement from July 28, 2025, presented as strengthening liquidity, yes. But it could also, perhaps more realistically, be viewed as a necessary measure in a genuinely challenging capital-intensive financial climate, not just a sign of strength.
Shoring up the finances for the road ahead.
Right. It's good they can secure it, but the underlying question is, why is it needed right now during this costly transformation? It suggests ongoing, massive capital demands and a critical need for financial fortification.
That's a powerful point about the reliance on the cash cow expert. It really does seem like Ford is walking a very thin tightrope, but here's where it gets really interesting, I think. Because Ford's Q1 2025 earnings present a really intriguing picture of a company in transition. We start to see how they're navigating these shifts with some, truly strong underlying performances despite the challenges you've outlined. Let's zero in on the highlights that showcase Ford's resilience. Their adjusted EBIT. It came in at an impressive $1 billion.
Which beat expectations, didn't it?
It did. What's particularly remarkable is that it exceeded their own break-even expectation. To me, that points to really strong cost-cutting measures, robust pricing power, especially in that crucial North American market, a testament to operational efficiency. Their operating cash flow also saw a significant, very healthy increase, jumped to $3.7 billion. That's up, 165.6% from the previous year's $1.385 billion?
That's a big jump.
Huge jump. Indicates extremely healthy cash generation from their core operations. Absolutely crucial for funding the transformation and those massive investments we just discussed. They also ended the quarter in a very strong cash and liquidity position. $27 billion in cash, over $45 billion in total liquidity. That's a robust financial cushion. Gives them immense flexibility to pursue strategic initiatives, withstand market fluctuations, invest boldly. And demonstrating commitment to shareholders, they declared a regular Q2 dividend of 0.15 per share.
Holding the dividend steady.
Right. A clear signal of confidence in their fundamental financial stability and future prospects, even amid significant investment and industry change. So, while the macro picture is complex, these operational numbers suggest a company with considerable financial muscle.
While some of those top-line adjusted numbers might look reassuring on the surface, host, it's absolutely critical for our listener to look beyond those adjustments. We need to delve into where the real pressure points are for Ford's core financial performance in Q1 2025.
Okay, let's get into the weeds then.
First, let's talk revenue. $40.7 billion. That represents a 5% decrease from $42.8 billion year over year. And this wasn't some unexpected market slump. The company itself explicitly attributed this decline directly to planned factory shutdowns for new product launches and necessary inventory readjustments.
So self-inflicted but strategic.
Strategic, yes, but disruptive. While designed for the long term, they undeniably highlight the impact on immediate sales volume. Demonstrates the transition comes with a very real, measurable financial cost. It's not smooth sailing, it's intentional but disruptive re-engineering. Then there's net income. This saw a sharp, very concerning decline, down to $471 million from $1.332 billion the prior year. That's a massive 64.6% drop.
Wow, that's a big hit to the bottom line.
A substantial blow to genuine profitability. Indicates that despite some adjusted figures looking better, the actual money hitting the bottom line was significantly less. Correspondingly, their diluted EPS was $12, down sharply from 33 cents year over year. Represents a substantial reduction in shareholder value for the quarter, reflecting those enduring challenges in converting sales into true, unadjusted earnings.
Okay, revenue down, net income way down. What else?
And here's a really critical point, often overlooked: adjusted free cash flow. Ford reported a significant use of $1.5 billion in adjusted free cash flow. This is a dramatic increase in cash burn from a negative $0.5 billion in the prior year. That's a staggering 2,900% deterioration.
2,900%. So they burn through much more cash.
Much more. And this raises an absolutely crucial question for investors. Despite the seemingly good operating cash flow, why are they burning so much cash on a free cash flow basis? Think of it this way. Operating cash flow is like your paycheck coming in. But adjusted free cash flow is what's left after you pay your essential bills and, crucially, make all your big capital investments building new EV factories, pouring money into R&D.
So income looks okay, but spending is way up.
Exactly. While operations are generating cash, Ford is currently spending significantly more to build its future than what's left over, consuming cash at an alarming rate. It signals very significant ongoing capital expenditure that is effectively draining their cash reserves.
That's a very clear way to put it, expert. Highlights the immense investment phase Ford is in. Okay, let's break down the segment performance now, because this is where you truly see Ford's strategy in action, right? Where they're thriving, where the heavy lifting is happening. We'll look at the three main operational segments: Ford Blue, Model E, Ford Pro, plus the crucial Ford Credit arm. Let's start with Ford Credit, their financial services arm. This segment had an absolutely stellar performance, reported $580 million pre-tax profit. That's a significant increase from $300 million in the prior year.
Finance arms often do well in these environments, relatively speaking.
They do. This consistent strength comes from maintaining a high-quality portfolio, robust financing margins, high net receivables. Ford Credit is consistently strong, highly profitable, provides a reliable source of income, a bedrock of stability for the whole company, acts as a crucial internal funding mechanism. Okay, moving to Ford Model E, their electric vehicle division. Yes, it's true. The segment reported a loss. That's the headline many focus on. However, it's absolutely crucial to emphasize the significant improvement in that loss. Their EBIT loss for Q1 2025 narrowed to $849 million, down from $1.327 billion year over year.
So losing less money.
Losing significantly less money. A substantial 36% reduction in loss clearly demonstrates real, tangible progress towards profitability. Furthermore, this segment saw a massive 967% increase in revenue to $1.2 billion. Truly showcases explosive growth in EV sales, their deep commitment.
From a very low base, though, that revenue growth.
Well, true, but the trajectory is steep. They're focusing intensely on total margin improvement, taking a disciplined approach to new battery facilities, next-gen products designed for efficiency. On the sales front, U.S. retail sales for Model E grew a healthy 15% thanks to their Ford Power Promise campaign, offering benefits like guaranteed residual values, charging incentives. Shows they are gaining genuine traction, moving in the right direction.
While it's certainly accurate that the Ford Model E loss is shrinking, host, it's absolutely crucial for our listener to remember Ford Model E is still losing nearly $850 million in a single quarter.
Still a huge number.
A huge number. Yes, the revenue growth was impressive percentage-wise, but as I said, against a very, very low base. Started almost from zero. So while it shows percentage progress, the absolute number in terms of profitability remains deeply, deeply in the red. The path to sustained, meaningful profitability here remains incredibly unclear, highly challenging, requires massive ongoing capital investments with no guaranteed return. They are effectively spending billions just to bring these staggering losses down to a more manageable but still very negative number.
You're right to highlight the scale of that investment. It is definitely a long game, for sure. Okay, now for Ford Pro, their commercial solutions business. This segment continues to be an absolute powerhouse for Ford. Reported a strong EBIT of $1.3 billion. Even with a slight decrease, it robustly maintains its leadership in commercial vehicle solutions, seeing consistent, strong demand for their commercial vehicles, the integrated services, and critically, their paid subscriptions for telematics software solutions increased by a solid 4% quarter over quarter, reaching 675,000 active subscribers.
That subscription growth is important. Sticky revenue.
Exactly, a clear indicator of growing recurring revenue. Incredibly valuable, stable stream for any business, offers predictability, stickiness that traditional vehicle sales just don't.
Despite its undeniable strength, host, Ford Pro isn't entirely immune to headwinds. While the EBIT of $1.3 billion is robust, as you mentioned, it's actually a very significant decrease from the $3.006 billion they achieved the prior year.
Oh, right. That's a big drop year over year.
A steep 56.4% decline. Similarly, revenue for Ford Pro decreased 16% to $15.2 billion. This decline is largely attributed by the company to planned downtime for new model launches and something they call industrial pricing normalization in commercial areas.
Industrial pricing normalization, sounds like, lower prices.
It implies that even in this traditionally strong segment, Ford is facing pricing pressure, perhaps yielding some margin to maintain volume. Shows even their strongest segment is subject to challenges, deliberate disruptions impacting immediate profitability. But the segment that truly demands the most critical attention, where the most significant concern for Ford's overall health lies, is Ford Blue, their traditional internal combustion engine and hybrid division.
The cash cow.
The historical cash cow that funded so much for decades, and its performance plummeted in Q1. EBIT in Ford Blue fell to a mere $96 million, down from $901 million prior year.
Wow, from 900 million to under 100 million.
A staggering 89.3% drop. While iconic models like F-Series and Bronco continue to lead their segments in sales volume, this dramatic decline in profitability shows the core ICE business, despite volume, is under immense pressure. Expected sales decreases, negative currency impacts. This raises that fundamental question again. Can they truly sustain their costly, challenging transformation into an EV and software company when their traditional high-margin cash cow is seeing such a dramatic, precipitous reduction in its ability to generate profits? The very foundation they are relying on is eroding, and eroding quickly.
That's a sobering perspective on Ford Blue,
Yeah.
expert. Truly highlights the challenge of managing this complex transition. So what does this all mean for investors? For Ford's future outlook, Ford stock performance since the Q1 earnings release on May 5th, 2025. Well, it tells a really interesting story. Shows a company that, in my view, has kind of found its footing amidst what you've rightly identified as a challenging transition.
How so? What did the stock do?
Well, there was an initial flat or slight dip right after earnings, sure, but we saw a very quick, decisive recovery. The stock stabilized effectively around $10 to $10.50 through May, then moved into a clear, sustained upward trend in June and July. This culminated in a significant surge. July 1st, 2nd, 3rd closed at $11.35, $11.77 by July 10th, nearly its 52-week high.
So a strong rebound after the initial reaction.
A very strong rebound. From my perspective, you can interpret this as investors gaining renewed confidence. They saw the adjusted EBIT beating expectations, recognized the continued strength of Ford Pro and Ford Credit, and perceived positive market sentiment regarding Ford's aggressive hybrid strategy and software efforts as key drivers for future growth. Suggests the market is starting to believe in their transformation story. Looking ahead to the Q2 2025 outlook, there's continued optimism building among analysts. Zacks Investment Research, for example, predicts Ford to exceed Q2 EPS estimates, always a strong positive signal. Furthermore, TipRank's AI stock analysis gives Ford an outperform rating, target price of $13, suggests what, 15.25% upside potential from current levels? Their year-to-date stock performance also tells a compelling story of resurgence, up approximately 20%, driven by robust hybrid sales, ongoing margin improvement efforts, strong operational momentum.
So hybrids are a key part of that positive narrative right now.
Absolutely. We continue to see significant strength in key segments, too. Ford Pro expected to maintain strong demand. Impressive sales for Super Duty trucks, boasting over 750,000 paid subscriptions, up 20% year over year. That growing recurring revenue is a huge advantage. Ford Blue, despite pressures, still seeing strong sales for iconic models. F-Series up 11.5% in Q2, Bronco up 44.7%, Maverick up 26.3%, Ranger up 36.3%. Massive volume drivers, cash generators, and Ford Credit expected to continue its robust performance, reliable profits, crucial stability.
So the core products are still selling well, volume-wise.
They are. Finally, their recent strategic moves bolster this optimism. That $3 billion term loan credit agreement from July 28th, a very positive sign. Proactively securing liquidity, strengthening financial health for future investments, critical operations. They're also actively launching new, compelling models in Q3. Explorer Tremor, F-150 Lobo, targeting high-growth segments like off-road, high-performance trucks, which typically command higher margins. All of this indicates to me a company with a clear vision, strong underlying assets, and the financial agility to pursue it, even if the road ahead has bumps.
While the recent stock bump is certainly encouraging, host, we need to consider the full picture. and the significant multifaceted headwinds Ford continues to face. The narrative isn't purely one of consistent upward momentum or unbridled investor confidence.
Okay, let's hear the counterpoint.
Let's revisit the stock pattern with a more critical lens. Immediately following Q1 earnings, May 5th, stock opened $10.23, closed $10.17. Next day, opened $10.09. This initial dip highlights an immediate negative investor reaction to those headline numbers, the decline in revenue, net income.
The unadjusted numbers, you mean?
Exactly. Furthermore, we saw clear volatility late May from $10.79 down to $10.17. Early June, it even dipped to $9.88, briefly breaking that crucial psychological $10 line. This indicates underlying investor caution, sensitivity to Ford's internal performance, and broader market conditions. Suggests the recent July rally, while significant, might also be heavily influenced by external market factors. May not be entirely sustainable based on Ford's internal performance alone. The market remains undecided, I think.
So maybe not fully convinced yet.
Perhaps not fully. The Q2 2025 outlook, while having some positive analyst calls for beating estimates, also comes with substantial expected year-over-year declines in core metrics. Analysts are actually forecasting Q2 revenue between $41.7 billion and $46.5 billion. That's a projected decrease of 2.6% to 8% year-over-year.
So lower revenue expected compared to last year.
Lower revenue. Similarly, expected EPS is between $0.34. That's a significant projected decline of 27.7% to 36.2% compared to $0.47 in the prior year. So even if they beat those lower estimates, the underlying year-over-year trend remains negative. Indicates a fundamental contraction in profitability compared to the previous year. This isn't growth, it's managing a decline.
That puts the beat into perspective.
It does, and here's a crucial, significant point of uncertainty. Ford actually withdrew its 2025 full-year financial guidance entirely. Why? Tariff-related uncertainty. This introduces a substantial level of unpredictability for investors, makes it incredibly difficult to project future earnings with any confidence.
It's old guidance. That's usually not a great sign.
It definitely adds risk. To put a number on it, the company anticipates an estimated $1.5 billion negative impact on adjusted EBIT for the full year 2025 due to these tariffs. That's a massive drag on profitability. Cannot be easily offset. It's a looming external threat.
$1.5 billion hit from tariffs alone.
Wow. Significant. Looking at segment challenges for Q2. Ford Blue, the traditional cash cow, expected revenue decline of 12.7% to $23.27 billion. Wholesale volume projected to decrease significantly, 635,000 units versus 741,000 prior year. Demonstrates ongoing, intensifying pressure on the traditional core. Ford Model E, while revenue is expected to grow 20.4% to $1.38 billion and losses are shrinking, it's still an expected loss in Q2. And notably, Q2 EV sales actually saw a decrease despite hybrid sales increasing.
EV sales decreased in Q2. That seems counterintuitive.
It is a critical indicator that the EV profitability challenge persists, not easily overcome, despite all the investment and focus. Even Ford Pro, strongest segment, expected Q2 revenue decline of 3.2% to $16.45 billion. Suggests even its robust performance faces headwinds, not immune to broader pressures or Ford's own disruptive transformation.
So challenges across all segments, even the strongest ones.
Pretty much. So while Ford is focusing on EV profitability, the market remains intensely competitive. New players emerging, rivals adapting aggressively. New model launches are crucial, but success is never guaranteed in this saturated market. The company's continued reliance on its strong balance sheet, liquidity exemplified by that $3 billion credit agreement, while positive for financial access, also indicates a perceived need for financial fortification in what is undeniably a volatile, capital-intensive, uncertain environment. These are all substantial interconnected risks warranting careful consideration.
It's clear that Ford is in a truly fascinating, deeply complex transition, isn't it? They're trying to balance this immense heritage, decades of industrial prowess, with the undeniable urgent demands of a tech-driven, sustainable future. We've certainly seen their immense strengths, particularly in areas like Ford Pro, which continues to be a consistent profit driver, and their strategic expansion of the hybrid portfolio that's genuinely resonating with customers, showing real sales momentum. They are making determined efforts to transform, investing heavily in software, pushing aggressively into electrification. It paints a clear, if challenging, path forward.
Indeed. But as we've explored, we also cannot ignore the very significant headwinds they face. The rapidly declining profitability in their traditional core business, the persistent multi-billion-dollar losses in the EV segment draining crucial capital, the relentless, intensifying competition from both established players and agile newcomers, and of course that substantial cloud of tariff uncertainty. These are not minor obstacles, host. They're fundamental structural challenges that could significantly impact their long-term financial performance and their ability to successfully execute this ambitious transformation.
It truly is a dynamic, almost dizzying time in the automotive industry. It raises an important question for you, our listener, as you consider Ford's journey. In this rapidly evolving landscape, what kind of automotive company will ultimately thrive? Is it the one that manages to transform its existing century-old empire, or will it be a completely new player built from the ground up specifically for this new era? What do you think?
And perhaps beyond the numbers and the strategic pivots, consider the broader implications. How will these profound changes not just affect the companies on Wall Street, but also the way you interact with transportation, with vehicles, in your daily life? The stakes are incredibly high for everyone involved, from the boardroom right down to your own driveway.
We really hope this deep dive has given you a comprehensive understanding of Ford Motor Company, its rich history, its complex present, and its uncertain future. If you're hungry for more insights, maybe want to see the data, the visuals come to life, remember to check out our YouTube channel. That's Market Insight Cast, Visual Companions, many more deep dives there. Now, please remember, the information discussed in this deep dive is strictly for informational purposes only. It is not financial advice. Any investment judgment and the responsibility for any decisions made based on this information are solely yours, the listener. Furthermore, this deep dive was generated with the assistance of AI based on the provided source material. While we strive for accuracy and comprehensive coverage of those sources, there may be differences or nuances compared to other information sources or potential errors inherent in AI-generated content. Always conduct your own thorough research and consult with qualified professionals before making any financial or personal decisions. Thank you so much for joining us on the deep dive. Until next time, keep digging deeper.